Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, June 13th, 2023. What I'm going to do in this one is start out with a very brief update on the very near term outlook or levels to watch, if you will, for the market, particularly QQQ and SPY. Then, real briefly, jump over to the longest term big picture, speak to that real quick, and that'll take care of the markets in 10 minutes or less. And then I wanted to do an update on the semiconductors. I mentioned that earlier today, talking about the different semiconductor indexes and ETFs that track those indexes. And of course, that has a lot to do with the markets. Semiconductors are a component of the tech sector, and they're probably, I think it's safe to say the biggest beneficiaries overall on balance of the whole AI hype, whatever you want to call that. All right, let's start out here with QQQ. So this is that pretty big level now. It's come, in my opinion, and that's that 357.69. I've talked about it quite a bit. We had a boom, 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 boom 4 there. We had that little wedge breakdown, went on to hit our first target. Second target on NQ, but that was because the trades happened, outside the regular trading session. So what I've done is I've color coded that. That's to me a pretty big level. You have the uptrend line I pointed out earlier today, a little minor uptrend line. If that breaks, that would likely be the catalyst for a move down there. Bulls would want to see a successful back test if we do get down there, and then bears want to see that level break. So that would be, we'll call it sell signal 1, sell signal 2, and then the big one would come, I think, on break of T2. If you look, I think you can see it in the video, and if you can't, I'm going to turn it up for you. This is my volume of price histogram. Those green and red bars, they show you the volume that's been at each price level. So down below you have your volume bars. These are by time, minute by minute. This is a 15-minute bar. So every white bar here down on the bottom represents the volume for that 15-minute period, where the volume price histogram is useful because that'll show you again. It just tells us this whole trading range right here, bounded by those yellow boxes that I have, are where the majority of trades were made. We had a consolidation, then a breakout. Breakout, as I always say, is bullish unless it fails. And the volume at price histogram is useful because it'll show you that you can use those levels as support and resistance. So it shows the breakout. Breakout has occurred on relatively low volume so far, right in front of the Fed. Market's kind of in a holding pattern, and you kind of take that with a little grain of salt there, that breakout right now. And again, if it fails, it fails, and then that's bearish. Then the next level you'd want to see, you can see the volume of price histogram bars, that big surge right here, and there's a thin zone down below this area I'm boxing in here, and that takes us down to T3. And so a thin zone it's comparable to a gap. A gap, you have no trades, 0 trades, but here you had a breakout above this. You had 1, 2, 3, same thing, 4 reactions there, and then you popped it, you broke out. And then once it was clear the breakout stuck and was back tested successfully, boom, you ripped right up. So in other words, there were relatively few trades taken there. So the way it tends to work, just like a gap, once you enter these thin zones, you tend to backfill it. So again, sell signal 1 on a break of the trend line, 2, even better, fall back into the range. If you fall back into the range, it increases the odds you come down to the bottom. That'd be T2. And then if that breaks, T3. And at that point, depending on what I see on the daily chart and different sectors and everything else, the charts of the market leaders, that I may decide whether or not to add additional targets. Should we never even break back down there and we move up? As I mentioned, tomorrow's Fed day, you decide if and how you want to have your stops. If you're even in this trade, even if you're long and bullish, where your stops need to be, that's going to be up to you. Everyone has different positioning, but that's what I think is the most likely scenario, despite the resiliency of the current trend, based on the technicals. And let me just turn that down. So that's QQQ, and again, that's just a 15-minute time frame. Here, I'll show it to you on a 60 real quick before we exit, and then we'll get over to the semis. That's it on the 60-minute chart. This is a trend line that correlates with that T3 I have here. That's a pretty decent trend line. It hasn't been checked or visited in a while. Last time we visited it was right there. So that's also a potential pullback target. And then you have that 339 support just below. And then if that breaks, you have the top of that trading range, that big trading range there. That really the breakout, once we broke up above that and back tested, that gave us this surge up. That was the technical catalyst. Remember I talked about at the time, it's like energy building like a coiled spring. I was expecting a downside break, but all along I said, if you break to the upside, as long as the breakout holds, and it did, that would be the next trend or direction, and that certainly was the next direction. But we're back there. We have the negative divergence all the way through here on the 60-minute, the 15-minute I just showed you, and even the daily. When you look at the S&P 500, I colored up this level right here at about 418. It shows 418.29. That I believe is also a very significant level for SPY, the S&P 500 ETF. Let me change up the color here. And you have reaction high there. You came, checked it again. Finally, you broke out, back tested it, and boom. So just like QQQ, you have a minor uptrend line that gives you this wedge. Just like QQQ, you have divergence. That divergence is starting to steepen now. The slope of the divergence has increased a little there on the PPI or PPO, and it's been building just like QQQ for a while. So there's your sell signal number one, a break of that wedge right there. That's your initial target. And again, if we do get the breakdown and a pullback to that level, that is where the bulls, quote unquote, should be buying and stepping in. And if they don't, that's a break of support. Anything more than just a little whipsaw down through there, which is normal. You can see here, you had a little brief whipsaw to the upside, followed by a failure and a rejection. Then you broke out, and then you had a little back test there. So that's why you give it a little bit of room. But a failure there would bring us back down, and then this purple line is very significant down here, about 403. So first things first, let's see how the Fed goes. Just because we didn't get the big pullback before with the divergences, again, doesn't mean that they stopped working. I've always said it and repeated it 1,000 times. Divergences, A, are not a sell signal. They are an indication of a trend reversal, and B, they play out more often than not, but sometimes they don't. So it's not a 100% thing. If it was that easy, all you have to do is recognize divergences, put 110% of your leverage up on your portfolio, long or short, whether they're bullish or bearish, and sit back and make money. So no, it's not that easy. There's other factors involved for sure. But those are levels I'm watching, and now that's short term. Let's talk very long term here. Let's talk the S&P 500. Let's go out to this weekly chart, and let's do this. I've gone over a bunch of times lately the major indexes. The only thing that is distorting, and again, it's not a diversified index anymore, and it's much less now than it was in the past even. That's the NASDAQ 100. When you look at the S&P 500, the equal-weighted S&P 500, the Wilshire 5000, the Dow, all these other indexes, we are still at typical retracement levels to, say that this certainly could still be a bear market rally. Bulls will say what they want to say. Bears will say what they want to say. Like I said, once a trend has been, once you've had a trend change in your longer term trend indicators, at least the majority of those have fired to sell signals. You want to see them clearly undone. And we're pushing the upper limits, but we're not there yet. Now let's just look at this. This is the S&P 500. I put on arithmetic scaling just to kind of it'll help illustrate here. I'm going to pull in some other charts and show you that. But what you're looking at is, if you're not familiar, the last real bear market. When I say real bear market, I differ from the media. They still continue to this day to use an antiquated measure or definition of a bull and bear market as a drop or a rally. Rise or fall 20% above or below the previous highs. That's what they talked about. Now, back in the day, in the 30s, 40s, 50s, 60s, that was probably the appropriate definition. Somebody at some point kind of eyeballed and said, look, that's typically it. To me, clearly there have been two bear markets in the past 30 plus years. The first one started in the dot-com bubble when it popped back there. It was went for about 2.5 years, from March of 2000 down into the '02 lows right there, and then we had the financial crisis. Most of you, even if you're younger than me, you probably remember that one. It was back in 2000, just October of '07 to March of '09 were the official dates for the S&P 500. And everything else were just corrections. Some of these were double digits. COVID was a 36% drop in the S&P 500. But when I look at this chart, to me, what I see are three larger and clear distinct bull markets. One, two, three. And this one has gone parabolic. This looks a lot like the S&P and everything else. Looks like the NASDAQ. When you look at the NASDAQ 100, we can do the NDX or just the NASDAQ composite, either one here. Let me just type it in for you. COMPX. Yep, I had it. Nope, COMPQX. There it is. See, this is what we call a parabolic advance or a blow off top, where you have a strong bull market to begin with, and it starts to accelerate, and you go at a parabolic advance, which is an increasing slope, is how you define a parabola. You can see almost the same thing here. We've had clearly the strongest bull market in history, and where I'm going with this is the Fed in recent decades have become. You've had a series of extremely dovish Fed chairmen and chair people, everyone on the Fed, and they figured they could just keep printing more and more money, throwing out quantitative easing well past the point where it was really needed after the financial crisis, and they figured this new magic panacea, or this new formula. Print, and you just, we'll never have a recession again. Anytime the market hiccups, we'll throw in more quantitative easing. We'll throw in, we'll bring interest rates down again near zero. And because inflation is a thing of the past. That was the mentality, and then we all know what happened. So finally, Keynesian economics, or Economics 101 said, you print enough money, you're going to get inflation. So we got it. Okay, so you can look at it. Again, the point I wanted to make is these, to me, 36%, 20-ish percent right there are nothing but corrections in one of the largest easy money induced bull markets, or if not in history. And that one was pretty darn big up there from about the mid 90s all the way up to 2000, again, as it measured. When you look at it again on arithmetic scaling, it kind of distorts it a little. There's log scaling, and that kind of puts it in percentage terms. That's the problem when you use linear scaling. It's using the same point increase, but when you go from 1,000 on an index here to 1,100, that's a 10% increase, but only it was 100 points. When you add 100 points to 16,000, you don't move the needle, and that's why, again, I typically prefer log scaling, but for the sake of this example, I put it back. I'm going to put it back to arithmetic and show you and look at the market. Remember, the NASDAQ composite was chock full of all those .coms back then. A lot of people comparing the AI hype and it could be early stage AI bubble. The AI, I believe it to be a bubble, but maybe I'll call it a micro bubble now. If anything, it's not anywhere near the scale of the .com bubble, and it has a potential to be. So let me just say this: don't fall in love with what the market or anyone thought on what the market can or must do. So here's where I'm going. I'm going to zoom in now. And I'm going to pick up right here at the beginning of the this bull market. Again, my opinion, 2009, that was the start of the bull market. And you can see what's happened there in the S&P and where we're at. Now I'm going to pull in a couple charts that I find interesting. This one here, I've posted it in the past. It's all over the internet. Unfortunately, it gets a little blurry when I blow it up. I'll pull it down for you. Here, let me try to do that first. Okay, here it is. I'm going to zoom in, and there's different variations of this, but it's a pretty accurate thing. It says you have these are the stages of a bear market.
Market data connection lost.
Okay, and so you have this stealth phase, and that's when no one kind of realizes you're in a bull market. Think 2009, 2010. Then awareness phase, where everyone becomes aware. Okay, now it's been a couple, year more. We're up, 30%, 40% off the bottom, whatever, and you're well into where everyone's aware and acknowledges. Those that were trying to make a case for bear market can no longer do it. Kind of like what I'm talking about.
Connection reestablished.
Then there's this point where you get the first big sell-off. When they say the first sell-off, obviously they don't mean that literally. It's the first sell-off that says bear trap, bear short, and they get squeezed. Then you get this mania phase, And you can see we go again parabolic, right? And it's a new paradigm. That's what they call it. There's first, it starts with media attention, then enthusiasm, greed, delusion, and a new paradigm. And that is exactly where we were. Exactly, in my opinion, where we were in 2001. Nobody back then was talking about a recession in 2022, 2023. Very few, or a bear market or anything like that. And again, it was that that fallacy that the Fed could continue to print, stocks would go up forever. Anyways, look at the where we're at. Then we had the the first big drop, and then this rally here, and this is where, if I'm right, that little map you have in the shopping malls or at theme parks, a little you are here. This is about where we are. So again, these are the major legs down. You have this return to normal. There's been a flood of headlines lately. Barron's really leading the pack about the new bull market. We're now in a bull market because the S&P 500 is finally up 20% off its lows from October, just on the closing basis. So it's a new bull market, and there's more room to run. And boy, they're flooding out those headlines. Anyways. So if we're going to have it, then this is, again, this is not anything. There's not a hard level here. It's just the kind of the visual. So let me just show you now that chart. So here it is. I'm just going to show you the parallels. And if you want, I'll go back real quick and we'll show you the parallels in previous bull markets. Never take a chart like this on face value just because somebody created this. I didn't create this one. Pulled off the internet, and there's others like it. Look at the previous bear markets. Again, the two that we have in recent history that most charting platforms are going to pick up on because the markets were in their modern form. Remember, there was no NASDAQ 100 back in 1960, or even the S&P was coming up. You had the Dow, and it was 30 stocks. So, and those last two bear markets are the best measure to really work off of, in my opinion. And so you can see, so this is where we took off. This is that takeoff, the stealth phase, right? All the way here. And in my opinion, COVID right here was this first sell-off bear trap, right? That's where very distinct, stands out, by far the biggest. Again, in my opinion, just a correction. Call what you want, 36% drop. But again, those terms don't fit with this super easy money. Incredible amount of government and intervention by both the federal government and the Fed, especially since COVID, has just gunned up and put the market on steroids in the past 15 years or so. And so it's just like I always say, like natural gas. If you want to call 20% rally or 20% drop a bull and bear market in natural gas, well, guess what? I've seen those in a single day, and I've seen natural gas go up 50, 60, 80% in a matter of months. So everything's relative. In the stock market, if you want to know my opinion, again, it's more of a visual thing. You can take a look and tell what's a bull and a bear market, but it would certainly not be 20%. The last two bear markets were over 50, about 55% in the S&P, bigger than that in the NASDAQ back in 2000, much bigger. But also about 55% in 2008. So there's kind of a gauge right there. The only bear markets in recent decades both took out over 50% drop. Then maybe you want to use at least a 40% drop from low to high. Same thing on the rallies. All right. So that to me very, very much looks like that first sell-off, the first big one, bear trap, and then boom. Then you see that parabolic run up, and then you have the bear market that started that many, including the media, are now declaring over officially, that it ended in October. But again, by most metrics, and even just eyeballing this chart, that is a bear market rally. So I can't promise that's going to happen. I do think it will, based on fundamentals and technicals. And when it does, it will, once the turn is in, I promise the stocks market will start heading down first, and the headlines will follow. They will rewrite, they will come out, and increasingly you'll start to see the reasons. They'll fill in the blanks. The media always retrofits to come out. Their job is every day to write a headline every single day. I've seen this so many times where there's a big up day. Dow's up 300 points, 400 points, and they cite the reason why. I've never once seen them say we don't know why the the Nasdaq 100 rallied 3 or 4% today, or dropped 3. They're always going to assign a cause, whether that's the actual cause or not. Quite often it's technically induced, and then quite often also it is a fundamental catalyst or some news headline or something, and big earnings beat of a big company. So that's that. So that's where I think we are. Let me show you one other one that fits in here. I found this one today just looking for a cleaner version, because when I zoom in they get blurry, and for some reason all these ones online are just saved in a small format, so when you copy the charts. But I mean, look at this, is just exactly what this bull market looks like from 2009. Shakeout move. Then now there's COVID right there, right? And then that blow off top. I mean, tell me that you cannot find an overlay. And this chart was probably made, I don't know, years ago, because this is, again, the cycle. And I've done it. You can go back and you will see these shots across the bow before the top. You saw it in 2006, before the '09 top, and before the Great Recession. And you saw the same thing happen in, I think it was 1998. Was that the one, the shot across the bow before the top in 2000? So again, these traits are very common, and it speaks. What I like about these charts, they talk about the kind of the sentiment, what's going on at the time. And so this is what we need to watch for: low or high. Bulls want to see at this point, let me get rid of this chart, obviously they want to see the S&P take out that high. If that's the case, there is no argument. Nobody can argue that you're still in maybe there'll be another bear market, but if you take out the previous high, then that is, this was, and that would be a, pretty powerful move. Oh, that's not my live chart. That's my live chart. So yeah, if we take out that high, we're going to be up over 31%, and we'll see if we get there. So again, to me, it's all going to happen soon. That's why I keep talking about the same thing, because despite the little pop in the last few weeks, last month or so, really since it happened when I went on vacation to Kauai, about 3-4 weeks ago now. That was when we had that breakout, and I'll get to that in a second. We had that one pop up, largely induced almost exclusively by first you had the FANGs kind of leading the pack, big tech, and then NVIDIA, which is, I think, unarguably the poster child of AI. If there's one stock, you might say, when you think of AI, everyone thinks of ChatGPT. Well, ChatGPT, it's not a publicly traded company. Microsoft has a stake in them, so then Microsoft was the first one kind of latching on to that. In ChatGPT, I've said this, AI is nothing new, but it was, cool to the layman, to the common, person, when you can sit there, because it had that conversational model, and that was really cool to say something and have it write articles and take tests and all that. So that is, it's neat, it's gadgety, and I can see the future potential. AI again is just, this is another iteration and improvement in AI. But again, where's the beneficiaries? Microsoft, like I said, has a stake in there. They incorporated into Bing. I don't play around with it. I know people that do. I don't think it's, it's not making me use Bing as my search engine yet. If someone tells me that's the way to go, then sure. But where I'm going with that is NVIDIA certainly had the biggest impact, because they are the, they have the most advanced chips now that from what I gather and what their earnings said is, they are certainly receiving orders, and again, they're eating Intel's lunch and AMD and everybody else's, especially on that aspect. So, but there's a lot of hype, a lot of extreme overvaluation, everything. We're going to get the chips in 1 second. So I just wanted to share that those very, very uncanny common traits that first big correction, the final blow off top, and the where are we now. So if that's how it's going to play out, I think it needs to do so soon. And where I started this video tells you the levels to watch. We go up a lot more, it starts to change things. Now let's talk semis. There's the S&P 500, there's our divergence, nothing's different. All right, so let's start out here with SOXX. This is the one forever and a day. I know there's been 3 main ETFs out there: XSD, SMH, and SOXX. I've always gyrated towards SOXX for 2 reasons. Number one, it tracks the PhilX SOX Semiconductor Index, which was the original and one and only, especially back in the day, you can track the stocks here. Let's go on a weekly chart. SOX dot X dash dash X is the actual index, and you can see this one goes back into the 90s, so you can chart it. And because it was really the first to market index, if you will, and then they followed with the ETF, and there were a couple other ETFs that came around that time. That's one reason I use this. It also has some leveraged versions. SOXS is in Sam, and then SOXL, obviously the S being for short, the L being for long. You know that. So if you want to juice them up, those are your, and then there's some, I think, some two-timers out there, two-time leverage. But here's what I wanted to talk about here. So what I did today, noticing this unusual pop, and again, this is where, just to kind of recap the semis, because I know there were a lot of comments out there. People acted like this was the worst trade in the world and everyone lost everything. Like I said, I haven't batted 1,000. Nobody bats 1,000, always warn, but I batted 800 on the market easily in the semis, short most of the way down, catching a lot of these rallies on the way up. Most recently was on, you can go, it's all on the site, did a video on January 11th, giving a target right here, this level. I know this is my busy chart, but you had this previous reaction high. We were bound down here, I think, on the 11th. Hit that for, what was that? I think it was about a 9% gain. There it is, January 11th candles right there. I have to grab next. It's where T3 is, so I'm going to grab there to measure up to the blue line. So we swung that up, hit that target for a 12% gain, turned around then, shorted it right after that. Got out, posted, closed that out, shorted on the 8th, hit the second target zone. That was good. That short was good for about an 8% drop, and made multiple, that was the original there, went down, hit, there's T1, T2 zone, which is from here to here. And then made multiple, pointed out multiple add-ons or objective short entries up to this line, but staying, anything we needed to stay under that line. And there was our breakout candle. That's when I was on vacation in Hawaii. Popped it, and again, that would have taken out any and all reasonable stops, especially there. So that trade was stopped out on that breakout. And it was a powerful breakout, and that was NVIDIA. That was all NVIDIA right here, this ramp up. And now, again, it's a little disproportionate to the overall semiconductor sector, and this is what I wanted to talk to you about. So today, I pulled up the holdings. I'm going to zoom in for you here. Here's SOXX. Let me make sure that's what we've got here. Yeah, this is iShares SOXX. Click on holdings down here. We jump down to the holdings, and you can see the weighting here. So where I'm going with this is SOXX is the QQQ, if you will. If you want to say the semiconductor sector, which is a sector of all the semiconductor stocks, instead of this particular ETF being more like SPY, the S&P 500, or the Wilshire 5000, or the Russell 1000, which is more diversified, you have an extreme concentration in just a handful. In other words, the weightings are unbalanced. They're market cap weighted. NVIDIA represents 11% of that ETF. Broadcom 9, so right there is 20, and then you have AMD. If you add AMD or these two, there's 30. That's 38. There's another 42. So right about here, just these top names right here, the top, what is that, 6, 7 or so, 8, maybe, make up half, 50% of the returns, and there's a lot more in there. You can see 4 pages. So when you go down the line, it doesn't matter what the other ones are doing. So where I'm going with this, it's a lot like the stock market, where it's this particular ETF is not really representative, the performance of it lately, of the semiconductor sector as a whole. However, if you're trading it just like QQQ, that's where your gains or losses are. So I will say this, on the way down, those that go up the most, it'll have the same effect, just like QQQ, when the next leg down comes, whether it's a bear market drop, another leg down like I think is coming, or whether we're in a new bull market and there's going to be a next big correction. Usually the big tech leads the way down as well, because you have the money coming out, and the same thing, those fund withdrawals coming out of the big indexes, they're sold down proportionally. So this one, I do believe, when the next big leg, whenever it's whether it's coming soon or whether it's coming months from now or even years from now, SOXX will most likely give you the most bang for your buck on the downside because of this weighting. Whereas if you want to kind of get an eye on how the sector, how the overall semiconductors are doing, that's sure. Here's SMH, also even more unbalanced. Let me zoom in for you. So I told you there's three big ones as far as volume and the size of those. SMH is even worse, 17% weighting in NVIDIA, almost 12 in Taiwan Semi, and then AMD, so you can see. So again, you have the same thing. The top handful make up over half the returns. So if you want to be diversified, and that's usually the point of trading an ETF, is for diversification, so you don't have that. And again, shame on me. I just really, I was gone. NVIDIA blew away earnings, and it would have been, again, that trade was stopped out 6 ways to Sunday, anyways, by that point, once that breakout occurred. But if you want a more balanced, diversified ETF, or where I'm going with this, I'll still trade. I like trading the juice. If I'm going to be right on this, I'm either going to be right or wrong on the sector, right or wrong on the market. That's usually why I trade QQQ over SPY, because if I'm right on the direction of the stock market, I'm going to get paid better on QQQ, whether I'm long or short. Cuts both ways. If I'm wrong, you're going to lose more. But when analyzing, like lately, I've been using those equal weighted indexes a lot, the S&P, looking at that and being a little bit dismissive of what's going on in QQQ because of that distortion, that false picture it's painting. And that's why I look at QQQE, which is telling a completely different story. Again, other than the recent, just the last few days, a little uptick and improvement in market internals, but a few days doesn't make a trend. We'll see if that continues. So you can see here on XSD, which is the Spiders S&P semiconductor ETF. And we all know S&P, they're in the business. They have probably more indexes than anybody. So they've created a much more diversified index. This is the actual index, and this is the ETFs. They try to track. You can see they're very close because it's an ETF. It can't mirror it exactly, but very close. And so look at the balance here. In fact, NVIDIA is not even the top component. All right, so they're using a different methodology, one of which will again give you a better picture of the semiconductor sector as a whole, if you're looking for the health, not just what one or a handful of stocks are doing because of AI hype. So let's look at that real quick, and we'll look at a few of the holdings, and we'll wrap this up. XSD, this is my daily chart. You can see on here, again, simple stuff, divergent high, divergent high, divergent high, divergent high, divergent high, divergent, and there's divergent lows too. There's a big divergent low down there, divergent high, and divergent high. So we currently have a divergent high. Again, nothing is guaranteed, but that one was a 17% drop. This one was only a 10% drop. This one was, I have to go here so I don't move that trend line, 40% drop. That was double digits, probably about 10. I'm just eyeballing some of these, measuring the rest. 20% drop. That one there was a 44% drop. That one was easily 10, 12%. And here we are. So again, and we do have divergence on the other ones as well, but I want to say this one again, most accurately looking at the sector. You have the PPO poised to make a bearish crossover. It hasn't done so yet. So the same thing I've been talking about now for a couple weeks. We're really pushing that upper limit. There's that level I showed you earlier in today's video where the semis had a support, a trading range after they put in that big divergent high that started the bear market, and it was official when they broke that down, and then they got rejected on the back test. Here we are, right where we were after the breakdown and the subsequent back test in early 2022. We're back there now with negative divergences, both on the RSI and the PPO. The divergence will be what I consider confirmed if we turn down soon and make a bearish crossover on the PPO that effectively puts in a lower low. Because as I like to say, it is a momentum indicator and the momentum is higher. So if we go up, we're going to burn through the divergence and we won't have it anymore. So we do now. And if we go down, my targets are still quite a ways down. There's a bull market uptrend line. This is again, I view so far I framed and talked about this, what everyone else is calling a bear market, and you could call it that. Certainly, the drop from the 2000, the November 11, I'm sorry, November 2021 highs. That's beginning of January 2022 for the S&P, but tech, the semis and QQQ and all, they topped in November, right around the beginning of the year. But this is the primary bull market uptrend line. So far, from looking at this chart, this is simply just a correction in an ongoing bull market. And this correction, when you see a primary uptrend line, especially one very clean, this is our secular bull market uptrend line, every now and then you're going to come back and check that trend line. You checked it last in COVID. It is still a target I have for many individual semis as well as a sector, and we're not there yet. So again, I'm viewing this as the kind of return to normal, just like the stock market. But if I'm wrong, I'm going to be wrong soon, especially more so in maybe not in time, possibly in time, could be a week, 2 weeks, but more so in percentage terms. If we go up another 10% or so, you get close to those highs, you start taking out all the fib retracement levels. Here, I'll show you those. This is XSD. Here's your Fibonacci retracements from the high to the bottom so far. And we are right, this was a 61.8. It did consolidate there for a while, popped it this week. This week's not over. We'll see where we end up. Next fib right above is a 78.6. So again, we're kind of pushing the upper limits of at least fib retracements, but it's still a lower high at this point. It could still turn down. So that's bigger picture stuff. And now what I'll do is step down to, well, let me just go back to SOXX. Let me go to my weekly and show you on that one as well. I have there's that primary uptrend line. Again, we just got a little farther away from it. This rally has been stronger in SOXX than in XSD because of the overweighting of those stocks I showed you earlier. And this was and still is my, what I call my initial bear market target. Right off the highs here, I gave you earlier, back in early 2022 or late 2021, T1, which was hit, T2. So far, we reversed a little shy of it, and that's the first of either the uptrend line or that 271.18. Now, the uptrend line is going to come in first at this point because this thing is, in my opinion, just a slow roll. So that uptrend line, and if we take that out, then that 271, which I'd still favor. I think that 271 will ultimately get hit. Trend line will probably get taken out. Okay, now let's just look at the top holdings. I'm on SOXX, same difference. These are mostly the same, if they're not the highest weighted, like I showed you, NVIDIA was number 2 on XSD, but and it didn't have nearly the weighting, but it is an important one right now. It's, again, probably the one all eyes are on. There's the most hype in NVIDIA. And so back here, we put in divergent high. Back here, I gave you 4 targets on NVIDIA. First one was hit, second one was hit. That was good for a 67% drop. We hit T2 almost to the button and we bounced. That bounce has given us a marginal new high. There are a couple, but not many. Most of the semis that you're going to see have not done this. NVIDIA is kind of it's certainly unique, again, with the AI hype and what they are. They're a standout company, even in the last bear market. And the one before that, there were always companies that were just better fundamentally that went on when the stock market peaked. For example, the last bear market was October of 2007. There were quite a few companies that went on to make new highs and rallied into 2008, finally before they crumbled under the weight of their own self and the rest of the market taking them down. So that may be the case. And look, we still have, by the skin of our teeth, that was a divergent high, led to that 70 whatever some percent drop. This is an even bigger divergent high. You have the same divergence. It's been building, building, building. You have equal or lower highs on the indicators versus higher highs in price. So that's NVIDIA. I'm going to take NVIDIA most likely to come down to really get these going. But the thing about these semis in this sector, not all sectors, but in most, such as the semiconductors, birds of a feather flock together. There's a high correlation between these stocks. They all tend to ebb and flow with each other. Taiwan. Oh no, I didn't give you a video on the daily. I'm sorry. I just wanted to flip to 2 time frames. On the daily, you've got this big island right here, and so what you want to watch for in the coming days or weeks would be a gap down below that to put in a potential. It's only a potential island cluster top. That's a very potentially powerful reversal pattern. Otherwise, it's just high level consolidation, and we break to the upside, and that's going to be bullish. But these divergences tell me, and at least on the PPO, and extreme overbought. Last time we were this overbought on Nvidia, you can see the RSI's pinned it, or just recently peaked at 84. Last time it was that high was right here, right before the top, and a drop of, from that point, Nvidia fell about 67%. So there's that. Taiwan Semi, massive trading range right here. You can see this right there. Look at the bottom of that range was so important. That was a topping pattern right there. There's a case of a trading range. Had tried to break to the upside, got rejected. Finally, when it broke down, it was a clear breakdown. They rallied it to back test it, got rejected, and the stock never looked back. We are back testing that range right now. And for the first time, I don't know if that candle, yeah, I guess that was an earnings pop or something, got rejected there. But that's big, big resistance. That's the daily chart. The weekly chart looks like this. I made that my current final target. I guess at that time, when was that? I must have updated that on March 9th and closed that out and said that's my final target for now. But these are longer term targets. So it was a current final target. Expected a good bounce there. And we got it. And we bounced back to that S1. That was, again, key support. S1, R1 now, because it was support back at the top. Support, once broken, becomes resistance. And so, like I said, that's, there is tremendous momentum right now and resiliency in tech and semis. But a case can be made, a very objective case to short. This is TA 101. You either short a rally into resistance if you expect it to fail, or you wait for a breakout if you're bullish. But you don't go long on an overbought rally into resistance. So Broadcom, we're on the weekly. Big negative divergence. These are my targets. T1 right here. T4, like so many, this is where I think at minimum we're going to in the coming months to years, is a test of these bull market uptrend lines. The last time you visit it was COVID right here. And so that's where I think the stock's going. It's not going to get there overnight. Could take months, could take a year or more to get there, but probably not, because stocks tend to fall a lot faster than they rise. Daily chart, some icky, extreme overbought. I don't really touch that one. I don't have an opinion on it. I just don't like the chart. ASML, divergent high right around to where we broke down to before. Big, steep negative divergence too on the indicators. You got a little uptrend line there. That's what it looks like on the daily. And then on the weekly, again, this was my final target. It was hit to the button. And again, these were, added well in advance. Created that back on February 3rd, 2022. That uptrend line, that target. That's the text there. And that was to have a pullback to. So you see some of these have already come in and checked those primary bull market uptrend lines, where quite a few others haven't. And ultimately, the thing about that too is these bull market uptrend lines are getting long in the tooth. They generate off the late 08 or early 2009 lows. Sooner than later, all trends, come to an end. Doesn't mean these stocks are going to zero. It just means they will, after a great secular bull market that's lasted 15 plus years, they're going to enter a longer term bear market. And when that trend line's broken, then I'll most likely add a target right here at about 219. And again, we're at resistance, so just need a little evidence. Again, you can take a short into resistance. That's why I'm going over these charts, both as trade ideas and I just know from doing this a long time. If any of you are still even listening to my voice, there he goes again about the semis, you probably don't want to short them. Just like you didn't want to go long when I was bullish down here, or short back here. Again, I know that from the comments. There weren't a lot of comments. Oh, wow, Randy, I made, 30-40% there on that short, on the semis put back there, or captured most of that 13% rally off the January lows or whatever from that. No, but and that's what tends to happen. From my experience, I've done this a long time. After I've been on a hot streak for a while, Then everyone wants to take every trade, and that's when they start taking them. And then boom, finally one fails, and people put too much money into it because they think, oh, this is going to pan out. Because I've been talking about the potential for a big drop, and so I think a lot of people see dollar sign 30% drop in the Nasdaq. I'll just load up my whole account, and then it's going to put me up flush for make up for the last 3 years. It doesn't work that way. Take every trade, proper money management, diversification, and don't put too much in any one sector or correlated assets. If you're long and bullish QQQ and you're long and bullish stocks, you're not diversified. These semis and QQQ tend to move very highly correlated. They're both tech heavy, tech stocks, tech sector. Okay, a couple more. I can't go anymore. It's going to go forever. We're at the 45-minute mark. But yeah, there was that. Okay, I already covered that one. AMD put in that divergent high. It broke its uptrend line here, and it's rallied back to that point there. Let's see. I don't have a strong opinion, but I will say there is this steep little, sometimes it's these little divergences are the ones that once in a while surprise you and play out for a pretty sharp move. Either way, that's what it is. So you had a little uptrend line right there, broke recently, back tested. And remember, the thing about shorting back tests of trend lines after a breakdown is you can keep back testing. But what I like to see is a final, an impulsive rejection. And you can see that's what we got on AMD. So that in itself could be taken as a sell signal. But as I said, birds of a feather flock together. You want to increase the odds. You've got a lot of islands here on a lot of these stocks, these island cluster candles. So that one's at 117. Set a price alert. I'm going to lower it down a little bit and make it a round number, and then I will set an alert there, and I'll do it on some of these other semis, whether it's the horizontal support or trend lines. And if in a single day or a 2-3 day period, if I start getting alerts going off like popcorn, I know the sector's breaking down. And let me say this. And again, if you're still listening to my voice, you might think, okay, maybe there's another trade to be made here. Last one didn't pan out. But this is a hot money trade, a very hot money, scorching hot trade. These things are extremely overbought, overloved. Don't underestimate how quick money can come out of these. I'm not guaranteeing it, but when the tide finally turns, and the machines decide to hit the sell button instead of the buy button, and the institutions start dumping, and individual investors as well, these things can evolve very fast. So my point is, if you wait a week, you might have missed out. Where's this one going? At minimum, if it breaks 117, and so I get some other sell signals on the sector to confirm, at minimum, it's going to backfill that gap right there down to about 108. That's about 7.5. More likely fall down back here to that yellow line about 99.61. That's about 14 or so percent. And if my 30% plus downside on QQQ and new lows are correct, then this a lot of these semis will go on to make new lows, and AMD could easily fall well over 30-40%. But again, you're going to need a little work. Here it is, Texas Instruments, right at trendline support on the weekly. It's been dancing on it. And usually in a healthy bull market, when you come to visit it, boom, it's one and done, and then off to the races again with another strong uptrend once you've checked or came in and tested that trend line. Boom, COVID. This time, it's really their buyers aren't stepping in. Now, if you're bullish, look at this one. It's got a beautiful level resistance, about 186 right there. Maybe it wants to go up, put a marginal new high before the big drops in. Again, if and when this primary uptrend line is broken, especially if you get half a dozen or more of these semis, the big semis breaking those bull market trend lines, then that's increasing the odds that my longer term bear market scenario with bear market that's going to last years, not months. The last two real ones in recent decades, over 30 plus years, have been measured. They were over a year, but 1.5 to 2.5 years, so you're really measuring months, or 18 to 24 months, I think, on the last two. Whereas this thing, I think we're looking at probably a 5 to 10 year, possibly 5-8 year, maybe longer bear market coming up based on the macro fundamentals and everything else like that, and the technicals. Qualcomm, I'll tell you right now, best of a lot that I came across on the weekly. You have this nice clean downtrend line. Positive divergence right there. You have prices making lower lows, indicators making higher highs. It's right at trendline resistance now and price resistance. This is a weekly, so you don't buy that and probably maybe pull back. Ultimately, if it breaks out above there, that's 123 is your price resistance and the downtrend line. That one could run. That's what it looks like on the daily. This is the same downtrend line I just showed you. So now it's at resistance. Again, you don't buy a rally into resistance, especially overbought. You can see it getting overbought here. Could break out, but if it breaks out, it has a very high chance that it's going to at least come in and back test, possibly even fail. So I did want to point this out. Now, if the sector holds up and we start burning through some divergences, and this one does go on to break out later, that one I think looks better than most right now based on that. Other than that, turn off all the lines and forget about the divergences I've just drawn. This is simply a stock in a bear market making a series of lower lows and lower highs, and it's below the 200-day moving averages. It's below its bear market, or right at its bear market downtrend line. So and if the semis are going to drop 20, 30, 40% from roughly from these levels, Qualcomm's not going very far. Let me just say that. It's possible, but unlikely. All right, guys, I think I'll wrap up. There's just a couple more I really wanted to get to. Intel, this was one of, a long pick here off the bottom. We hit T1, T2. Then we broke out. Remember, we had this basing pattern here. We broke out once, failed it, but went up again. Now it's got negative divergence. There's the primary bear market downtrend line. If it can burn through the divergence, that's a potential target. But again, negative divergence at resistance. If it falls back below there, it's probably going to go down lower. Applied materials, same thing. I'm on a daily time frame here. Negative divergence. Hit that target right here. Target 56%. That's what I was calling for. Right to that level. Hit it. That was created back on January 4th of 2022, right when this thing started. Laid out that target, hit to the button. So again, a lot of these calls, and some of these were monster calls. Very few, even if you were calling a top on the semis back then, stocks like Applied Materials, it's very unlikely that, and many out there had that kind of precision as to where it's going to go before it bounced. And so far
market data connection
we're
lost.
Bouncing a little higher than I thought. If the bear market's not over, that may prove to be the end of the bear market.
Connection
we put
reestablished.
in a positive divergence there. There was every case in the world to cover that short and go long there. Would have been covered on the site at the time. Where we're at now, kind of a bit in no man's land. I can see some resistance. It was resistance here and then support right here. So you bring that line across, and it's the same story. There was that topping range right there with divergence, and again it was resistance right there in a trading range. We broke above it and then failed it there, and we're back there now. So a case could be made. And then what you do, of course, you zero in on the daily chart. Yeah, you can see it here. Here's the daily, about 145.50. There it is. See, that's that trading range, resistance, popped it, then it was support, then you broke it, back tested, failed, never looked back. This is the first back test of that level. So I'm going to stop here because I could go on and on and on, and I loved I'd marked up a lot of these charts, but you're seeing sort of a common theme. Just about all of them have big negative divergences, the same type of divergences that they had back when the bear market started. Yeah, it's powerful, kind of pushing the upper limits of a bear market rally, but unless those highs are taken out by the majority of stocks, not just one, not just NVIDIA, you can still make that case. It's a bear market rally, and especially with these divergences. So there it is, guys. Profit potential. There's a higher beta on the semiconductor sector than the NASDAQ. So if I'm calling for 30, 35%, which I am dropping the NASDAQ 100, then add another 10, 15% on here on the semis. Here, I'm just trying to eyeball it for you. Let's go back to SOX. My T2, it's not been hit yet. Let's just use that number, 271 right there. If that's going to be hit, you'd get about a 47% drop in the semis there. So you can take a shot here. Again, new trade if you want. Call it what you want. Maybe wait till the Fed's out of the way tomorrow. That would be good practice in my opinion. Give yourself a 10% stop loss. It's going to take you right up to the highs. Because the thing is, you can double top, but usually in this market, in the bull market in recent years, every time they run at and test a high, they pop it by a marginal amount. usually do it with divergence, and then the top is in. So you get even close to it, you're probably going to pop it. Just like I told you the other day on QQQ, that if they ran back up, got over that it's R1, S1 level, they're going to run at the highs, but then if they run at the highs, I'll probably pop it and make a marginal new highs, which is what they did. Okay, I got to be done here. 2 long videos today, but that's it. I've studied charts all day. I don't see a lot that stands out as screaming hard buy, hard sell signals, anything that I love. Like I said, commodities, I think it maybe makes sense to, have some positions there, continue to build if and as the charts develop. Many of those were at resistance today when I did the video. So as I said, not a good time to start that. If anything, gain a little pullback. And we did after that video ended. Wheat, corn, and soybeans, they all pulled back right off those levels. And so now you can either buy on the pullback, you get a better price, or wait for the breakouts. And then on the stock market, like I said, there are no sell signals at this moment. There are rallies into resistance, especially in the semis, as I just covered on QQQ. Really want to see that 357-ish level go in the comparable level I gave you on SPY. And then if that goes, really want to see those second yellow lines I gave you there go on the shorter term charts. Okay, we'll wrap it up here and pick it up tomorrow with the Fed rate decision. This has been Randy Finney with Right Side of the Chart. Have a great day.